I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market started the week with a massive rebound off of last week's lows as investors picked bottoms on oversold stocks. And many of the badly bashed stocks really had good rebounds. In the previous 3-week crack, the S&P 500 had moved down 12%, the NASDAQ 16%, and 22% to the downside for the Russell, in what was the worst decline since the year the pandemic started. The upward spike started last Friday afternoon, actually, in a quiet market that all of a sudden accelerated upward on the close, and on Friday the S&P 500 had closed up 105 points. But that was only the beginning in this 4-day romp to the upside, as Monday, Tuesday, and Wednesday saw huge gains of 84 points on the S&P 500, 30 points, and 43 points. That made a trough to peak move of 373 points in the S&P 500, a giant rebound in there. And gains came as the techs rebounded and money moved into energy stocks and many things that had moved down a lot. And in energy, Exxon came out with some news. They had a big beat in their earnings, and they said that they're buying back $10 billion in stock. So that really helped the energy sector. On Tuesday, there was some news that came out that was a bit ridiculous. Janet Yellen came out, the Treasury Secretary Janet Yellen, and she said $30 trillion in debt, government debt, big deal. Deficits are not an issue. We have low rates. So in other words, we don't have to worry about paying interest rates on it. And that is one of the most short-sighted comments I have ever seen. And the fact that Yellen, or the likes of her, are in a leadership role running our economy, well, that makes me shudder. Wednesday's surge came on the back of Google. It was a good beat on earnings, and they came out with news that they were going to split their stock 20 for 1. So that means a $3,000 stock is going to be much more like a $150 stock. But that split, well, doesn't really mean anything for valuations. The stock likes to go up on that news because investors think, well, it's cheaper, so people will buy it. But it's not really cheaper, it's just a lower price. And usually spikes on the upside on split news pull back. Then on Thursday, all that ended abruptly. Actually, Wednesday afternoon, as Facebook, that's Meta, came out with their earnings, and they showed that their users had backed off. That's the first time that had dropped ever. And Zuckerberg came out and said, our path is not perfectly defined, and 22 is our next chapter. And he knows what they were is dying, and hence the name change. If competing with TikTok and Google in short-form video is where they're headed, well, they're in huge trouble. First of all, that's lower margins. And secondly, they're way behind on competing in that area, and they're going to go nowhere with that. This, by the way, will also hurt Alphabet because if that news is that, well, there's less advertising going on and there's lower margins for what is a growing sector for Alphabet, well, you could see that Google stock really starting to suffer because I think that earnings we saw there might actually be a peak. The news also hurt a lot of those social media stocks, Snap, Pinterest, Spotify, Twitter. They moved down very sharply on that Facebook news. But Snap snapped back here on Friday as it reported earnings, and the stock gains 50%. Absolutely crazy from that, well, very depressed low. And after the 50% gain today, the stock is still down 55% from its peak. So that stock has gotten bludgeoned. If you think the present 17-18% PE in Facebook is a deal, I say to you, be careful. I think it's a value trap, and they're selling an unknown future. Many stocks that had rebounded had moved down very sharply again on that Facebook news. And the S&P 500 on that Facebook news was down 65 points pre-market. Turns out, well, that wasn't the worst of it because it closed down 112 points. The NASDAQ was down 4% in what was the worst day since 2020. Also, in the news, oil had moved up to over $90 a barrel, and here on Friday it moved up to $93. I'll say a little bit more about that in a minute, as a huge spike in this oil market has things really looking like they're disrupted. Also, the dollar got slammed as the euro currency actually had the euro zone had a tone change from their central bank as the ECB said that, now they actually may be raising rates and they're tightening the tightening policy. Well, that has the euro currency with a bid and actually has me and the dollar in, I'd call, an analytical whipsaw. Friday, well, it's actually Thursday after the close, Amazon news came out and the stock absolutely rocketed to the upside. It was up 18% at one point. And the S&P 500, which was down that huge 112 points, well, the futures were up about 57 points on the news overnight. Amazon then pulled back a bit and now up about 12%. And oil surged over $93. And that brought sellers in also on the news on the payrolls. So the bond market got absolutely cracked. And as those yields moved up to recovery highs, sellers did come back into the market. Now, the market today has been moving on both sides of unchanged. Now up unchanged as I'm reporting this around midday, and has been up and down 20 points in the S&P 500. So a lot of two-sided trade and a lot of action going on right now. Those payroll numbers, well, U3 as expected ticked up to 4%. But the shocker was that payrolls gained 467,000. Now, the estimates were really wide, from up about 125,000 to down 400,000. That huge gain was accompanied by a huge increase in adjustments in the last couple of months. So that was another something like $500,000 payroll jobs created. And that really has the bond market on its butt today as yields are absolutely spiking. Of course, those numbers, as you can see, as they come out monthly, are really meaningless because of all of these adjustments. If there's anything that is important by this, that would be the wage inflation that we see, as it was up another 0.7% last month, and that is meaningful. And that is what has the bond market selling off so much right now, and of course gives the Fed more reason to be very aggressive. There's a lot of talk going on right now based on these numbers of the Fed acting ahead of the March meeting. I doubt that based on the nature and the makeup of these Fed members. They really want to take this go slow approach, and the fact that they are still buying treasuries, buying governments right now all the way through March, well, that's another sick thing. Well, the stock market, well, I think it has two major problems right now. One, growth stocks were mostly killed. Yeah, a couple of them ticked up that we saw, like Amazon and Google. But for the vast majority of what were the growth stocks and all of those stocks during the pandemic that were moving up because, well, they're going to move up forever, of course. Well, there's no mercy on those, as they were massively overpriced and they absolutely get crushed on any kind of a miss. And what we're looking at, right now is, I think, a lot of disillusionment from those investors that were buying those things. That whole idea of looking out 10 years in growth, well, I think that's crushed right now. And these disillusioned investors, I think sometime this year, are going to panic. I think that probably comes after a rebound, and I think that rebound will come and hook a lot more investors. I'm going to say more about the timing on that as we get later into the show. You know, when you look at stocks like Clorox, that's down 14% today and down 40% off of the pandemic, you get an idea of what's going on here. And a lot of people's portfolios are really crushed. And there's that disillusionment. And that's what happens when you get start to fall off of bull markets into bear markets, like I think we are right now. And number two is really central banks. Well, their tightening phase, that change has just really started. And it's different. All of the people that write to me and say, well, stocks keep going up while they raise rates. I mean, historically, we see that all the time. Well, there's nothing historical about where we are right now. We've never seen this before. And central bank tightening right now is coming off these historic lows in interest rates. And they're doing it at a time when growth is going to slow. All of that money that was pushed into the economy, well, that's going to be falling off. And the yield curve is going to flatten very quickly. As we see that beginning to happen right now, we could see an inverted yield curve with long rates at 2.5%. That, of course, would be wild. That's really bad for the bank stocks, and the financials would lead the market, in my opinion, on the way down. And just as those central bank actions brought big upside moves with all that liquidity that came in the market, the unraveling of that is going to be, well, 12% down in the S&P, that's nothing. So I still think that the stock market is going to continue this downward move that we're seeing into late February to early March. And then I think in the spring, we're going to get a rebound. And that might last even into the summer. But I think the failure after that, well, that's going to be a huge decline and probably the biggest that we'll see in 2022. So that bounce that we expect to come in the spring, well, that's going to be an opportunity to get out of some of these stocks. For the week, well, the S&P 500, it gains about over 1.5%. Same thing for the NASDAQ. Russell's up about 1% and the Dow. But this is, far cry from where they were earlier in the week. The S&P 500 was up 4% at one point, and the NASDAQ up 5%. So they gave a lot of those gains back. Bonds, they were crushed here on Friday on those employment numbers and wage inflation. 30 years down about 2.5 points on the week. And the 10-year yields move up to 1.92%. That is a gain of 14 basis points on the week. That is quite a surge in interest rates. Gold market, well, gold's up about $15 right now on the week. Silver around unchanged. And we don't think they're going anywhere until the second half of this year. Dollar, that's down 1.7%. That's a really big decline, and that's on the Eurozone change in policy by their central banks. And that completely reverses the last week's gain and puts the dollar in a precarious position. We'll talk about that for our members in the Future Speak show on Wednesday. Remember, Future Speak, fantastic show where I look at about 50 charts in just over an hour and all of the futures and index markets, and that's for level 2, 3, and 4 members. Oil for the week, well, there's a report out that Russia is planning to invade the Ukraine based on some contrived report that something that's going to stimulate Russia to act. They call that a false flag, and that has, of course, had oil moving up, though it's coming off of its highs here right now. Not by much, trading over getting close to $93 again. That's a 50% gain. That's $30 in just 9 weeks as it gets up here to $93. Coming up, Ari's going to give you a preview looking at short-term trade planning using the askSlim analytical style. It's a great lesson that he's going to bring you. I'm going to look at yields. I'm going to take a little picture here, looking out about the next 6 months. Then Matt is going to give you a great little illustration here of our daily stock index report that is just fantastic, that we're making available for almost nothing, just for level 1 members. So he's going to show you that coming up. And then I'll look at the stock market, looking at a 1 to 3 month view. So I think you're going to find that all just unbelievably interesting in this really packed show that we're bringing you today. Let's remind you that please go to the askSlim website and become a free member. I think you'll enjoy what we are doing. We will give you lots of notices and stuff, and then you'll get a feel for who we are. If you're watching this on YouTube, please do subscribe to the channel. Click on that notification bell, and YouTube will let you know when we post videos. And do like this video, give it a thumbs up. On Twitter, follow us at askSlim. And for all the information on membership and any questions you would have on our huge offerings of education and analysis, do write to Matt at askSlim.com. All right, coming up here is a preview on stock sectors. Matt does this every Thursday, and he either looks at a stock sectors group or he does a great lesson on short-term swing trade planning. And that's what he's going to bring you right now, as he looks at one stock in here that he's going to share. But for level 2, 3, and 4 members, there's 11 stocks in here. And we're doing something special this week for level 1 members. So take advantage of our level 1 special. I'm going to show you in a few minutes. We're going to share this for our level 1 members also, the full video. But this is just a preview of that, where he's going to look at one stock and teach you a lot about the way we set up our trade ideas. So great work here that you'll see by RV.
So this is Synchrony Financial, symbol SYF, and you can see that this had been in a very positive mode here. For Synchrony, we have a dominant weekly cycle here, which is broken up into these minor half cycles. And we have drawn in how these dominant cycles have formed over time. And you can see we've had positive cycles forming here with higher cycle highs and higher cycle lows. And each of those cycles led to new highs in that consequent rising phase, as you can see right there. So all that really played out very well. However, you can see we had this large horizontal trading range here going on with not a lot of upside progress, and now we have a breakdown. So what this really looks like is a very large rounded top here in SYF, and we are now, if we look at just our cycles, we are in a left-hand translation where the high has formed early in the cycle, and we would look for this to sell off for the rest of that cycle. Now that next low is only due out in the later part of June to early July, so there is likely significant risk here on the downside. So in the intermediate term, which is the next 3 to 8 weeks for us, we will look for this zone from around 43.90 to 46.20 to hold it on the upside, and then for this to get a roll down into that next minor cycle low. Now that next minor cycle low is due right around that middle part of March time period. On the downside, we have an intermediate 127.2. That would be our first downside target here into that March time period, and then we would look for one more hit on the downside after that, going out into that late June to early July time period that I just referenced. And all of this would really only be valid on an intermediate term basis if we stay below that 46.25 area. If we go ahead and switch to the daily, you can see what we're looking at here. So this has been in a bearish overall pattern. You can see we've had real failures versus that 78.6 fib right there and right there. We never got any closes over that. And overall, we've had lower cycle lows forming here in each of these cycles. So this is a more bearish look here in SYF. We are looking for this to form one more lower high and then for this to roll down. What are our levels on the upside? We have a zone from around 43.80 to 45 or so. And if it closes above 46.20, that would really render this idea no longer valid. And we are looking for a move at least through that prior cycle low here at 39.80. We'll have to come up with our targets once that swing high does form. But we would look for, at the very least, a move through that key daily cycle low at around 39.80. So that's the overall picture here in SYF, a very bearish look. And this is really the method that we walk through for all of our trade ideas. We look at our weekly and daily chart, illustrate our levels on both the upside and downside, and then walk through our cycle analysis to show you the timing aspect associated with the idea. So if you are interested in this, definitely sign up for either a level 3 or 4 membership to get these trade ideas to you live.
All right, let's talk about interest rates. We have looked at interest rates as in a time frame that we thought it would be moving up in a significant way. That would be a time frame where the Treasury market, the futures, would be moving down very significantly. And that's exactly what has happened. So I wanted to take a look here at interest rates and take a little bigger picture view here for the next 6 months, and especially get some focus on really the next couple of months, because I think this is going to be significant for stock traders. Basically, I think the rising interest rates are bothering the stock market, and we've had some really huge amount of declines in many of the stock groups, being held up by, of course, still the mega caps, by some of those. And the stock market, though basically really responding to the prospect of higher interest rates and getting very, very much weaker than it has been before. So let's take a look here as we switch over to a long-term chart here of TNX. This is the 10-year chart where we're looking at monthlies. So a little bit of, just to catch you up on what we're looking at in here, this is cycle analysis. On the bottom are cycle brackets. These represent essentially the energy in the market. There's nothing hocus pocus about this. This is simply money flows. This is a dominant cycle in here with money flows where they're moving in other words, rates going up because money's moving out of bonds, or bonds are declining. And in here where bonds are rallying and the treasuries yields are going to the downside. And there are 3 different harmonics in here: a 22, a 44, and a 66 month. Now, in time frames where all of those are coming down together and nesting, as you see right over here, there's a lot of downward force from the minor, intermediate, and longer term cycle patterns that we see in there. This is the declining phase in interest rates, and you could see how hard it got hit here. Same thing right in here. There were actually 2 of them coming down, and here were 3 of them, which made the low at about 40 basis points in the pandemic panic. So that's what we're looking for, is a monthly chart in here going back to 1997. So it's about 25 years we're looking at. These green zones right in here are areas where there is likely rising periods in interest rates, as you could see right in here, where this either the intermediate or a group of them are moving to the upside. In this case, all 3 were moving to the upside, and then all 3 moving to the downside in interest rates. So what I had told our members in our big picture analysis in here is that when I've done this earlier in the year, is that it was likely that we were going to see rates rising, and that the projections were 1.8% to 2.2% in early 22 and possibly 2.6% by 23. This is that rising phase that we have right in here, as you could see. Now, the minor cycle in here actually formed with a bullish triangle in interest rates, as you can see right in there. And then as this began to move up, the interest rates began to accelerate again. So you have, in this case, 1, 2, and 3 of the energies moving to the upside, pushing up interest rates or pushing down the treasury market. So what we're looking for in here is a continuation to the upside in interest rates. That target right over there at that 61.8% fib is about 2.15, 2.16%. This one right up over here is at about 2.6% way up there, and that's that possible up by 2023. And that would be if it really got a rally way up over here. The fib target zone that we have in here comes out to about 1.9 or 2.2%. So that's really where our target is right now over the coming months. That is our projections on futures were for futures, Treasury futures to decline out into a period out somewhere between around March 1st or even into May. So there is a time frame in here where interest rates can continue to spike on the upside. So that's a look at the monthly. As you can see, I want to remind you that if you're not familiar with cycle analysis, please go to askSlim.com to the workshop tab, and there's a lot of information in there that you can learn about our cycle analysis. So this is the monthly look, and that points for interest rates to go up. As I said here, in January 22, all phases were up. They were all rising, and you can see how that's working beautifully. Now, the next chart that I'm going to show you now is a weekly chart. Now, again, this is cycle analysis, and this is very important for you to see. You could see this cycle right in here, bottom right in here, bottom here. That said that where they were both coming down was going to be a big decline in interest rates. Well, we knew it would be a decline, but there's no way we knew it was going to get down to around 40 basis points on the panic. You can see this cycle bullish. That's that upward arrow as it has a higher bottom than where it was. We call that a base. And here you can see another higher bottom, another higher bottom, another higher bottom, all of those setting up in these cycles. You can see the beautiful rhythms that are in here and these rising phases. We made a note that this right over here was support, and when it dips into this area here of support, it means sell futures, and the futures are now moving down very significantly. So what we're looking for in here, and you can see the minor cycle projected right up in here, that little skinnier dotted line, and the dominant cycle projected in here. This calls for a decline in futures or a rise in interest rates, and that's about 2.1% right there. That takes you out to sometime in April. And this, if it makes it up to that level right over there, which is the big resistance, that's that 2.19, 2.2% right there. So all of this time frame in here, outside of maybe a little dip where you'll get a rally in the futures during a brief period in here, all that points to increased yield still here out into sometime in April. So the monthly chart that I showed you just looks like it will continue to give us higher interest rates out into potentially out into the springtime. And the shorter term here on the weekly chart is the same thing. All of that is very much in line with what we have been looking at for quite a number of months, with the bond market acting very well within the cyclical projections that we have brought for members. So again, you can learn about cycle analysis by checking out our workshop, and of course we teach it in almost everything that we do. And in the little piece that RV shared with you just before this, there's a good example of how we use that for swing trade setup. So I thought this was very important to bring, because interest rates, which are rising, and the decline that we see in treasuries is likely to remain, and that is negatively affecting the stock market. And I think we will see that here out into March, maybe April, and then a reprieve as the bond market gets a bounce, and I think the stock market does at the same time. That is a look at interest rates, our 6-month view. All right, we have a special going on right now for Level 1 members. 50% discount for all of this. I'll show you what it is really quickly, and then Matt is going to show you something fantastic. What you get for the Level 1 membership is the Slimulator Momentum Tracker. That's for longer-term holders, over 1,000 symbols. You can scan and sort, and it gives you a great idea of the condition for the next 3 to 6 months on the individual stocks or futures or indexes. The stock index report. This is a daily piece of technical analysis that Matt puts out. He's going to explain that to you in a moment in a short video, which is just fantastic. It's technical analysis on the major indexes. You're going to get our Spider weekly ETF review with technical analysis on the major sectors. You'll be able to have access to our new Trader and Investor Workbench, where you can organize and prioritize and save and track all your own work. You'll get the Market Week Show archive, and you can review our analysis and style in there. And you'll be in the askSlim, most of the askSlim live events, and you'll get those replays, about 70 minutes packed with all of our teaching and analysis and special member videos. And this week we're adding the entire video of what RV just showed you on short-term swing trade planning. 11 stocks in there, and he's going to do a tremendous amount of teaching. So we're adding that to the special level 1 videos that you get. So coming up right now is a brief video where Matt is going to share an overview of our stock index report, a daily snapshot. I think you're going to find this very interesting. So stay around, watch this, and then you will see that great report that's put out every single day by Matt.
Hello, fellow traders and fans of technical analysis. This is Matt with askSlim. In this brief clip, I'm going to provide a tour of a key service now available in our Level 1 membership, the askSlim Stock Index Report Daily Snapshot. This daily report is a comprehensive technical review where we apply the askSlim methodology to the S&P 500, NASDAQ 100, and Russell 2000. It is designed for active short-term and intermediate swing traders who look to use the major indexes as a proxy for their trade planning. In each daily snapshot, we apply the askSlim technical methodology to project forward in time, price, and direction. Let's take a look at a recent daily snapshot. This snapshot is from February 1st of 2022. Each daily snapshot has 5 main sections. The first are technical summaries for each index, where we cut through the fluff to get to the main stuff that you need for trade planning. We summarize current technical conditions, including directional bias, cycle timing, key price levels, and where things could change. We do that in all 3 of those major indexes. In the second section, we take a look at our custom askSlim charts for each of the indexes, which include our proprietary momentum indicators, and they're annotated with key technical insights, like important support and resistance zones for the 2-hour daily and weekly charts that we do our analysis on. Let's take a look at an example of those. So in the S&P 500, here's our askSlim charts with the 2-hour, the reversal scalp momentum indicator. You can see that here. That bottom was forming, and then we had that shift in the momentum up into the short-term resistance zones. It's an example of the 2-hour. Our daily charts with our color-coded candles that are represented by our slim ribbon momentum indicator. And then also our reversal scalp on the daily chart here. And then we apply our cycle analysis with our cycle brackets at the bottom to assist with key timing, risk and reward timeframes. And then we also have our weekly charts with our cycle brackets with the key timing in terms of those risk periods and where you could have opportunities for new rising phases. So we apply our technical analysis and cycle analysis on these charts, again, to give you a sense of the key timing, price levels, and directional components. All right, in this next section, we're going to take a look at our price projections. And we do this at multiple time frames. And the objective here is that we are thinking through the trade planning process for determining those upside and downside price projections at those multiple time frames, short term, intermediate, and longer term. So let's take a look at a recent example. Here's our short term outlook that we had. And again, this was from the February 1st snapshot report. And what we have here are upside reviews where we provide a price projection and a downside overview where we provide a price projection. We indicate the date that the price projection was reported. We also indicate the anticipated projection zone, and then we provide you with the area or the level where reevaluation of those projections would be needed. So in this case here, we indicated on 1/31 that the likely price projection in the SPX would be 45.49 to 45.90. And also we indicated that the downside price projection would be 44.72 to 44.10. Let's take a quick look at how those results played out. Pull over our 2-hour chart. And as I mentioned, the first price projection on the upside was 45.49 to 45.90. Again, this was for the short-term outlook, which was indicated on 131. So that was right around here. And we had 45.49 to 45.90. So today we actually reached 45.95. So that was pretty much a bullseye in the upside. And also on January 31st, we had indicated that on the downside, the projection was 44.72 to 44.10 in the short term. Well, today we reached on a low 44.70.39. So that was a bullseye on both the upside and the downside. That means that we're today on Thursday the 3rd, we'll be going back and updating our upside and downside price projections for both of those targets. All right. In the fourth section here, what we have with the daily snapshot, we take a look at our technical evidence comparisons. That includes our momentum across multiple time frames for the 3 indexes, SPX, NDX, and RUT. And at a glance, you can see what those conditions are, and we update those as they change on a daily basis. In our final section here, we have our cycle analysis table, where at a glance you can see our cycle configuration, so the pattern structures in both, this is the daily time frame, the weekly time frame, and then also our cycle phasing, when we are expecting changes in that phasing based on the cycle time frames, as well as what phase we are currently in. So all important information as you are considering your trade planning and looking for a comprehensive report that is dedicated to unbiased technical analysis. That's what you receive with the askSlim Daily Snapshot. I hope this tour of the Daily Snapshot was helpful. We ask that you take advantage of our special Level 1 trial offer, and we look forward to having you become part of the askSlim community.
And yes, this level 1 membership, 50% discount. Everything that we show you right now, great introduction to our services and education and analysis. Special price. It's normally $19.95 a month for this, and that is an unbelievable bargain anyway. But a special price, $30 for 3 months. So it's $10 a month that you're going to be paying at this introductory price. That is 48 cents a day for everything in here that you're getting. It's an incredible deal. If you're not an askSlim member, or if you're a free member and you want to upgrade, please do take advantage of this. You'll get a great idea of what we do and get this great report every single day for the next 3 months. Only 48 cents a day, $30. How can you not get this? Go to askSlim.com to the top of the website, and you'll be able to join. There's a little 50% off green banner up there, and just click on that. And you have problems with that or any questions, do write to Matt at askSlim.com. Great stuff here. Please do subscribe right now to this Level 1 membership. All right, stock market, 1 to 3 month. We're going to look at the SPY. I left QQQ on here, but I'm actually not going to share the QQQ. Oh, maybe I will. Maybe I'll just put it on there for you to see. So let's take a look here at the SPY. I'm going to move from this to SPY and look right over here at these cycle patterns in here. I did a little lesson, and I'm going to expand on the lesson in this like I did last week. So again, this is cycle analysis. What I want you to see is the rising phases that have been in here for all this period of time. These are the rising minor cycles right in here. As you could see, there's about 3 of them in each of these dominant patterns that you see right there. So let's take a little closer look so you can see right in here at these last cycles, and you'll get a great idea of where we are. So this is the minor cycle right there, and right there, and right there. There are 3 of them here as illustrated on the bottom. This is the basic look at the cycle. If they were moving sideways, well, then each of these cycles would be up and down to the same levels. However, there was an uptrend in here, and this establishes the uptrend, as you can see, as each of these cycles is illustrated just as it occurred in the uptrend. All of them making higher highs, all of them having higher troughs, and then a higher high made in here. Now, if you're a subscriber of ours and you look at the daily chart, there's actually 3 of the minor cycles right in here that you see that show up on the daily chart. And so each of these cycles right up over here made up of 3 cycles right in here, as you can see. Where are we right now? Well, this cycle took out this bottom, and that says that this whole period in here is likely to decline. And it says that rallies in here are likely to fail. You can see what happened right in there is, well, that was up, S&P 500 was up 4% for the week, is now up more like 1.5%. And this area here is where all of the cycles do line up together, and it gives you this yellow period of risk. So this decline right over here, which was 12%, is very likely to be taken out down over here. We're looking at this being a 12% correction and potentially 15% correction here. Big support at the major 23.6%. That's at about 411 on the SPY. And in here we have these 1, 2, and 3 cycles right there that comes out into sometime around the mid-March or early April period. And this should bring you, well, the decline we're in right now, another attempted rally, then a bigger decline down over here, and another attempted rally, and a bigger decline right there. There you can see the way this sets up, and each of these were positive cycles, and once this made a lower bottom here, it turned the trend down, and now we're looking at this right over here. This cycle right here made up of the 3 moves right there, and this is very basic cycle analysis lesson that I'm showing you. It makes the highest probability that the stock market will continue down into mid-March to early April, as we show you right in here. These 2 vertical dotted blue lines are the time frame, the time zone for when this declining phase should end, and then getting back up to this right over here. If you remember earlier in the show when I talked about the bond market and gave that great lesson on yields, I said that sometime in probably in the spring there would be a rebound in the Treasury market, and I thought that that would coincide with a rebound in the stock market. Well, this is probably that period there, but then it's going to get into more risky periods out over here. So lots of people that say to me, well, the stock market is about to blast through the highs. Well, anything could happen, and I could be wrong, and I would have to reanalyze it if that happened. But right now, the highest probability is that rallies will fail, and the stock market will move down in a significant way. So this is the 1, 2, 3 moves that I'm talking about here in the daily chart. If I switch over to that daily chart right there, you can see in here, that's the setup right in there that we're looking at. This rally came, hit the sell zone, actually left an abandoned baby. Here is the 1, 2, and 3 moves that we're talking about that I showed you on that weekly chart, and that is likely to bring, well, some more weakness out over here for maybe a couple days, an attempted rally, and then bigger declines coming out over here into that period into March. So that's the look at the daily chart on the SPY. Here's a look at that weekly chart, and those 3 moves I just showed you down over here, likely to bring you lower prices. I would say reasonable to be down 13.5% to 16% by the time this is over with on the downside. And I told you I would share the QQQ, so I'll put that up right over here. I need to get the QQQ weekly. I'm sorry, I don't have it on QQQ. I have it on NDX. So lots of people ask about that, but I have it on NDX, and you can see in here the same pattern on NDX, and the likelihood that that this failure that we saw right over here is the kind of action that we're going to see. as it got into the sell zone. And again, our target down over here under 13,000. That's 12,900 at that major 38.2%. So, I had put up on this slide that I was going to show the NASDAQ, and I forgot to change the slide, so I decided to bring that up. So, let's look at the stock market. Choppy, wide swings, the biggest volatility that maybe we have ever seen on point movements. Of course, coming off all-time highs, and the likelihood that the stock market will continue to the downside into the mid-March to early April timeframe is where that sets up right now. I hope that you thought that absolutely incredibly interesting. I want to remind you, please go to askSlim.com. Make sure you become a free member at least, or take advantage of that level 1 deal that we just showed. That level 1 deal is only going to be now for the next few days, and that'll be over with. On YouTube, subscribe to the channel. Click that notification bell when you'll know when we post our videos. Do like this video, give it a thumbs up, and watch the member videos that we put in the playlists in there. I think that you'll find those very informative. On Twitter, follow us at askSlim, and please do write to Matt if you have any questions on anything we showed in here on our huge offerings and education and analysis. I hope that you learned a ton, and this was absolutely great. I want you to be so unbelievably careful. It is so crazy out there. I'm always wishing you great trading.
Well, I'm going to the city and I'm going to do a city show. And I know all my fans want to learn how to make some dough. I've been